You're about to make your last car payment. You've been writing that check or watching that auto pay hit for 4, 5, maybe 6 years. Every single month, like clockwork, rain or shine. Whether you had a good month or a rough one. Whether you needed new tires, your water heater broke, or your kid got sick and you spent $300 at urgent care. That payment was always there. Non-negotiable, immovable. And then one day, it's gone. Meet Marcus. He's 34, lives in Columbus, Ohio, makes about $68,000 a year. And 3 weeks ago, he made the final payment on his 2020 Honda CR-V. The loan was $28,000. He stretched it over 60 months at 6.4% interest. When it was all said and done, he paid nearly $4,800 in interest on top of the purchase price. And his monthly payment? $547 a month every single month for 5 years. The day it cleared, Marcus sat at his kitchen table, opened his banking app, and just stared at the screen. He was expecting fireworks, maybe some kind of internal parade. Instead, he felt something quieter, a weight lifting, a door opening. And then, almost immediately, a question that honestly should have been more obvious. What do I do with $547 a month now? Here's the thing. Most people celebrate paying off their car, update their Instagram, maybe treat themselves to dinner, and then they sleepwalk right into the next financial mistake. They either let that money vanish into lifestyle creep, or they go get another car loan, starting the whole cycle over again. But there's a different path. And in the next 10 minutes, I'm going to walk you through every single thing that changes, financially, psychologically, and practically, the moment you pay off your car. Because this milestone isn't just an ending. For most Americans, it's the most underestimated turning point in their entire financial life. And if you play it right, it can change everything. What's up, everyone? Welcome back to the channel. If you're new here, this is the place where we talk about real money moves for real people. No fake Lambos, no get-rich-quick nonsense, just the practical stuff that actually moves the needle on your financial life. Today, we're going deep on one of the most exciting moments in personal finance that almost nobody talks about, paying off your car loan. Specifically, what happens after, what changes, what you should do immediately, what most people get completely wrong, and how to use this moment as a launchpad toward actual financial freedom. Stick around, because by the end of this video, you'll have a clear, actionable plan for exactly what to do the moment that last payment clears. Let's get into it. Let's start by zooming out, because I think a lot of people don't fully appreciate how big of a deal a car payment really is until it's gone. Think about it this way. The average monthly car payment in America right now is $767 for a new car and $537 for a used one. Let's call it $600 as a rough middle ground. That's $7,200 a year. Over a 5-year loan, that's $36,000 leaving your bank account, and that's before interest. With interest factored in, depending on your rate, you could easily be looking at $40,000 or more for a car that's worth maybe $18,000 by the time you're done paying for it. Now, here's what I want you to really sit with. That $600 a month isn't just a car payment. It's a down payment on a house that never got made. It's the emergency fund that never got built. It's the Roth IRA contributions that never happened. It's the credit card balance that stuck around for years because there was never quite enough money to pay it off. Every single month, that payment has been silently competing with every other financial goal you have. It's been the invisible hand pressing down on the scale, making everything else just a little bit harder. And when it disappears, everything gets lighter. But here's the part that doesn't get talked about enough. The psychological shift that comes with being car payment free is almost as powerful as the financial one. There's something deeply different about owning your car outright. You don't owe anyone anything on it. No lender has a claim on it. It's yours. That's a feeling that a lot of Americans who've been in back-to-back car loans their entire adult lives have literally never experienced. Research on financial stress consistently shows that debt is one of the top drivers of anxiety and sleep problems in American households. And while a car payment might not feel as heavy as a mortgage or credit card debt, it's a constant, recurring reminder that you owe someone, month after month after month. Removing that reminder has a real, measurable effect on how you feel day to day. Marcus told me, and I'm paraphrasing here, that the biggest surprise wasn't the extra money. It was waking up on the first of the month and not having that little spike of anxiety he'd been carrying for 5 years. The quiet relief of knowing that payment wasn't coming. That matters. Your mental bandwidth has financial value, even if nobody ever puts a dollar sign on it.
Okay, so you've made the last payment. The emotional weight lifts. Now let's talk about the concrete, real-world financial changes that kick in immediately, and some of them might surprise you. Change number 1. You now own an asset. The moment that loan is paid off, you are the sole legal owner of your vehicle. That means your lender releases the lien on your car title. Depending on your state, either your lender notifies the DMV automatically, or you'll need to request an updated title showing you as the clear owner. Don't skip this step. Get your clean title in hand. It matters if you ever want to sell the car, trade it, or use it in any financial transaction. This is a bigger deal than it sounds. While your car was financed, it was essentially collateral. The lender had a legal claim to it. That claim is now gone. You have a tangible, sellable asset with zero debt against it. Change number 2. Your insurance options expand. Here's one that a lot of people overlook, and it can save you real money almost immediately. When you have a car loan, your lender typically requires you to carry comprehensive and collision coverage, full coverage, because they need their collateral protected. That requirement vanishes the second your loan is paid off. You are now free to reassess your coverage. Now, and I want to be very clear about this, I'm not saying you should immediately drop your comprehensive coverage. That depends on your car's value, your financial situation, and your personal risk tolerance. If your car is worth $20,000 or more, you probably want to keep it. But if you're driving a 2015 Honda Civic worth $10,000 and you have a solid emergency fund, dropping or adjusting your coverage could save you $50 to $150 a month. That adds even more cash back to your monthly budget. Call your insurance provider, have the conversation, run the numbers for your specific situation. Change number 3. Your debt-to-income ratio improves. This one has long-term implications that people rarely think about. Your debt-to-income ratio, DTI, is the percentage of your gross monthly income that goes toward debt payments. Lenders use this number when you apply for mortgages, personal loans, or refinancing. The lower your DTI, the better your borrowing profile. Eliminating a $600 monthly car payment on a $68,000 salary drops your DTI meaningfully. That can make a real difference when you go to buy a home or refinance something. It could be the difference between qualifying for a lower interest rate or qualifying at all. You may not be applying for anything right now, but this change silently improves your financial position in a way that pays dividends down the road. Change number 4. Your credit score may dip slightly, then recover. This one tends to surprise people, and it's important to understand. When you close an installment loan, like a car loan, your credit score can dip slightly in the short term. This happens for a couple of reasons. You're reducing the variety of credit types on your report, and if this loan was one of your older accounts, you're potentially shortening your average credit history length. Don't panic. This is typically a small, temporary dip of maybe 5 to 15 points. If you continue to manage your other credit responsibly, pay your credit cards on time, keep utilization low, your score will recover and often end up higher than before within a few months. The key takeaway? Don't run out and open new credit accounts to compensate for the dip. That'll hurt you more than help you. All right, this is the section that actually matters, because you can understand everything I just told you and still blow this moment entirely if you don't have a plan for where that money goes. The biggest financial mistake Americans make after paying off a car is something called lifestyle creep. That $600 a month slowly gets absorbed into eating out more, upgrading the streaming subscriptions, a little extra online shopping, a little more here, a little more there, and 3 months later, it's just gone. You have no idea where it went. Your bank account looks the same. Nothing changed. And the worst part, you don't even feel like you spent it on anything meaningful. It just evaporated. No big vacation, no major purchase, just 100 small, invisible decisions that added up to nothing. This is not a willpower problem. I want to be clear about that, because too many personal finance people make you feel like it is. Lifestyle creep is not a character flaw. It's actually the default behavior of money when you don't give it explicit instructions. Think of your freed up cash as a new employee who just showed up at your house with no job description. If you don't tell them what to do, they're going to just wander around, eat your food, and watch TV. You have to assign the work. The second biggest mistake? Going straight back to the dealership. I know it's tempting. You just freed up $600 a month, and car dealers can smell that from miles away. You go in just to look. They run your numbers, show you something shiny, and 6 weeks later, you're back to paying $700 a month, now for a newer car at a higher rate. You basically traded your financial freedom for new car smell. And statistically, the average American who does this is back in a car loan within 4 months of paying off their last one. 4 months! They never even had time to feel what it was like to be free. So what's the right move? Here's a framework that actually works. Step 1. Give the money a job before it disappears. The day, not the week, the day your last car payment clears, redirect that money somewhere specific. Set up an automatic transfer. Make a decision. Money without a destination always finds its way to lifestyle creep. I genuinely don't care where it goes at first. A high-yield savings account, your Roth IRA, a debt payoff fund. As long as it goes somewhere you chose before it gets a chance to dissolve into your daily spending. Here's a practical move. The same day your final car payment processes, log into your bank account and set up a recurring automatic transfer for that same dollar amount to go into a separate account. Literally the same day. Don't wait a week. Don't wait until the money settles. The reason? Your brain has been wired for 5 years to accept that this money disappears on a certain date every month. Use that conditioning. Just change the destination from your lender to your savings or investment account. You will not miss it. You already know how to live without it. Step 2. Prioritize in this order. Here's the order of operations I recommend, based on where most Americans actually are financially. And I want to walk through each one in a little more depth than most YouTube videos do, because the devil is absolutely in the details here. First, the Starter Emergency Fund, $1,000. If you don't have at least $1,000 in a liquid savings account, this is your first destination. I'm not talking about 3 to 6 months of expenses yet. I'm talking about a basic buffer that keeps you from going back into debt the next time something breaks. And things will break. Your car is paid off, but it will still need tires. Your water heater doesn't care that you just hit a financial milestone. Your dog will get sick at the worst possible time. Without a buffer, every unexpected expense is a credit card swipe. And that credit card debt compounds at 24% while your car loan was at 6%. You've already won that fight. Don't let a $400 car repair drag you back into high-interest debt. At $600 a month redirected, you can build a $1,000 emergency fund in less than 2 months. You do that, and you've already changed your financial life. That buffer is the difference between a minor inconvenience and a crisis. Second, eliminating high-interest debt. If you have credit card debt or personal loans carrying interest rates above 10%, this becomes the target the moment your starter emergency fund is funded. Here's the math that makes this obvious. The average credit card interest rate right now is hovering around 21 to 24%. Paying off a balance with 22% interest is the same as getting a guaranteed 22% return on your money. There is no investment on earth that consistently delivers that. Not the stock market, not real estate, not crypto. Paying off high-interest debt is the highest return financial move available to most Americans, and it's one that almost nobody talks about in those terms. Now, a lot of people ask me, should I tackle the smallest balance first or the highest interest rate first? This is the classic debt snowball versus debt avalanche debate. And the honest answer is, it depends on your psychology. If you're motivated by quick wins and need momentum, pay off the smallest balance first, regardless of interest rate. The psychological victory of eliminating an entire debt can fuel you through the rest. If you're more analytical and want to minimize the total amount you pay over time, target the highest interest rate first. Both work. The one that doesn't work is the one you quit. So pick the method that you can stick with and go at it. Third, the full emergency fund, 3 to 6 months of expenses. Once the high-interest debt is gone, this is where your freed-up money goes. 3 to 6 months of essential living expenses, sitting in a high-yield savings account. Not in a regular savings account earning 0.01%. In a high-yield savings account at an online bank, which right now can pay you somewhere between 4 and 5% annually just to park your money there. That's free money for having a safety net. Why 3 to 6 months? Because this is the number that separates people who get financially derailed by life events from people who don't. Job loss, medical emergency, family crisis, unexpected move. These things happen to almost everyone at some point. The difference between those events being a temporary disruption versus a years-long financial setback is almost always whether or not someone had this fund in place. Fourth, retirement contributions. Now we're getting into wealth building territory. If your employer offers a 401k match and you're not at least contributing enough to get the full match, stop everything and fix that right now. This is the single most financially irresponsible thing I see middle-income Americans do, and I say that with love. A 100% match on the first 3% of your salary is a guaranteed instant 100% return on your investment. It doubles before it even gets invested. There is no financial justification for leaving that on the table. If you don't have access to a 401k or you've already maxed the match, open a Roth IRA. In 2025, you can contribute up to $7,000 a year to a Roth IRA if you're under 50. That's $583 a month. If your freed up car payment is $600, you could essentially max out a Roth IRA every single year with just the money you used to send to your lender. The growth inside a Roth IRA is completely tax-free. You pay taxes on the money going in, and then you never pay taxes on the gains or the withdrawals in retirement. For someone in their 30s, that tax-free compounding over 30 years is worth an enormous amount of money. We're talking potentially hundreds of thousands of dollars in tax savings alone. Fifth, building toward your bigger goals. Once the above 4 steps are in motion, the world genuinely opens up. A down payment on a house, a college fund for your kids, starting a business, a taxable investment account for early retirement, travel. Whatever your version of financial freedom looks like, this is where the car payment money starts feeding it. The beautiful thing about getting to this 5th step is that it doesn't feel like sacrifice anymore. It feels like acceleration. You're not grinding toward a finish line. You're already past the wall that was holding you back, and now you're just deciding how fast you want to go. Step 3, run the math on what this moment is really worth, how you see this decision. Because sometimes we need to see the numbers to feel the weight of what we're actually deciding. Let's say you redirect $600 a month into a Roth IRA invested in a low-cost S&P 500 index fund. Based on the historical average annual return of the S&P 500, roughly 10% nominal or around 7% after adjusting for inflation, here's what that looks like. After 10 years, roughly $104,000. After 20 years, roughly $327,000. After 30 years, roughly $756,000. $750,000 from redirecting your car payment. And here's the part that should really land. Every single dollar of that, every cent of growth inside a Roth IRA comes out completely tax-free in retirement. At a 22% tax bracket, a $756,000 Roth IRA is worth substantially more than a $756,000 traditional 401k. We're talking about a real after-tax difference of over $150,000 just from the tax structure. Now, I know some of you are doing the math and thinking, but I'm 45. I don't have 30 years. Okay, fair. Let's talk about 15 years instead. At $600 a month, 7% average return, you still end up with roughly $190,000. That's not retirement money on its own, but combined with what you presumably already have saved, it could be the difference between retiring at 65 versus 62, or between retiring comfortably versus retiring stressed. The point isn't to make you feel bad if you're starting late. The point is that this specific moment, the moment your car loan disappears, is one of the clearest financial turning points most people ever get. The money is already gone from your lifestyle. You're already used to not having it. The friction of redirecting it is basically zero. All you have to do is not take it back. You already lived without this money for 5 years. The only question is, are you going to take it back or let it finally work for you? Let's get out of the abstract and into the real world for a minute. Take Ashley. She's 31, lives in Nashville, works as a dental hygienist, making about $58,000 a year. She paid off her Toyota Camry 2 years ago. $480 a month freed up. She did 2 things immediately. She opened a high-yield savings account and dumped the first 3 months of freed-up payments in there as an emergency fund top-up. Then she increased her Roth IRA contribution from $100 a month to $400 a month. She kept the other $80 as buffer money. 2 years later, she has $8,000 in her emergency fund. Her Roth IRA has grown from $4,200 to over $14,000 before that. She has 0 credit card debt for the first time in her adult life. And she still drives the Camry, which now has 94,000 miles on it and is still running fine. She told me something I think about a lot. I've made more financial progress in the last 2 years than in the 5 years before that combined, and I didn't really change my lifestyle at all. That's what getting this right looks like. Now, let's look at the contrast. James is 37, lives in Atlanta, earns about $75,000. He paid off his truck 2 years ago. $620 a month freed up. He celebrated, took a vacation on credit, and then 4 months later, leased a new truck. Payment? $689 a month. He's now paying more than he was before, on a car he doesn't own, with a lease that has mileage restrictions, and an end date where he starts the whole cycle over again. James isn't a bad person. He's not stupid. He just didn't have a plan. And without a plan, the default always wins. The default is more consumption. The default is the shiny new thing. The default is more payments. The difference between Ashley and James isn't income. It isn't discipline as some personality trait. It's whether they had a decision already made before the moment arrived. Make the decision before the moment arrives. So let's bring this home. Paying off your car loan is not just a financial event. It's a moment that reveals who you are, financially, and who you're going to become. It exposes the fork in the road. One path leads back to the same cycle. Another payment, another lender, another 5 or 6 years of a fixed obligation eating into your budget and your freedom. The other path leads somewhere completely different. More savings, more investment, more options, more breathing room. Marcus, the guy I mentioned at the start of this video, he made a decision. He redirected $300 of that $547 toward his Roth IRA and put the other $247 toward knocking out a small credit card balance he'd been carrying for 2 years. That balance will be gone in 4 months. When it is, he's going to redirect the full $547 into his investment account. He's already doing the math on what that looks like in 25 years. He told me, for the first time in my adult life, I feel like my money is actually working for me instead of just passing through. That's the real payoff. Not the last payment, what you do the day after. You now know exactly what changes when you pay off your car. You know the financial shifts, the title, the insurance, the DTI, the credit score. You know the psychological shift. You know the right order of operations for redirecting the money. You know the mistakes to avoid. You have the framework. The only thing left is to use it. If this video was helpful, hit the like button. It genuinely helps more people find this content. Subscribe if you want more of this kind of practical, zero-fluff personal finance content. And drop a comment below. Are you close to paying off your car? Already paid it off? What did you do with the extra money? I'll see you in the next one.